Okay, now, ladies and gentlemen, for our first topic or first week, what did we learn?
Production.
Sorry?
First week was introduction. It's
Yes. So not much of it lah. Okay, the second week.
type of
Um,
type of business.
call businesses, yeah.
Yes,
Organization.
business. Organization. How many type of business organization that do we have?
Oh, we have three.
Three.
Okay, and the first one is
A sole
Sole
proprietorship.
sole proprietorship. Second one is
Partnership.
Partnership.
partnership. And third one is
It's
Company.
a company.
company. Good job, everyone. All right. So, and then what did we learn in our second week?
We learned about the
Balance sheet.
balance. Yeah. It's the financial statements.
Second week.
Yeah, financial statements, right?
After business
Income.
organization,
Income.
Uh,
Income statement.
we learn about financial
Statements.
institution.
Oh,
Okay. So, what did we learn in financial institution?
about bankings and the rules.
Agency.
Yeah, agency.
Yes. Agency theory. Right? Who knows? Maybe agency theory can be really important for your final exam. All right. What else?
Well, the issues of agency, I think.
Okay.
Yeah. And what are the rules of financial system.
Sorry?
Financial institution and markets.
Financial institution.
And markets.
And also market. And so we learn about the intermediaries. Intermediaries. Or channeling. The channeling is that when we have surplus, that goes to deficit. And deficit will return the investment to the surplus. Okay, all right. So that is in second week. So what did we learn in third week?
Statement.
Financial
Financial
statements.
statement.
Income statement.
Financial
Statement.
statement. So what do we learn in financial statement? We learn three types of how to understand three types of financial statement. The first one is
The income statement.
Income statement.
statement. What is the formula for income statement?
Sales
Sales
minus
minus
expenses.
equal to profit.
All right. Okay. And the next one we learn about
Balance
Balance sheet.
income.
balance
Balance sheet. Yes.
sheets. And what is the formula for balance sheets?
Total assets equal outstanding debt plus shareholders equity.
Total assets equal to
The debt, outstanding debt, plus the equity of shareholders.
total asset equal to
Current assets. Current
Outstanding debt.
assets plus current liabilities.
Yes.
total asset
Equals to
current liabilities and current
Current
assets.
liabilities,
Total
current assets.
liabilities plus with total equity.
Yes.
Alright, okay. And the third one we learn about
Cash flow.
What is the cash flow?
cash
Flow.
flow. So what is the formula for cash flow?
Cash flow, operating plus investing plus
plus-
financing.
Operating plus investing plus
Financing.
financing
Will give us cash equivalent.
plus with initial balance equal
Yes.
to
Net cash increase plus cash equivalent at beginning. Okay. Cash equivalent.
operating plus
Plus
investing plus
Plus
financing
financing.
plus with initial balance equal to
Cash equivalent.
cash
Net-
plus cash
yes.
equivalent.
Yes.
Okay, now the next one is what do we learn?
The
And
ratio.
about the forecast.
Exactly what do we learn in the next week? Next week lah.
Yeah.
In week 4,
analysis.
Analysis,
Financial
financial
ratio.
analysis.
financial ratio. Okay. Fahad, can you give me an example of one type of financial ratio?
Yes, there is asset management.
Asset
Management.
management. Aziza, one type of financial ratio? One category, not type.
Liquidity.
Liquidity. Yes. Liquidity. Right. Nasir, can you name me the other one?
Debt management.
Debt management. GMT. Okay. Diana, can you name me the other one? Najiha, can you name me the other one?
Market value.
Market value. All right. Ali, can you name me the other one?
Profitability ratio.
Profitability. Good job, everyone. So that is financial ratio. And then after financial ratio, we go to 1, 2, 3, 4th week. What do we learn in 4th week?
Forecast.
Financial forecasting.
Forecasting. In forecasting, we learn about pro forma.
Pro forma, yes.
Perform.
Okay, pro forma form where we use the percentage of sales from this year to predict what happened in the next year.
Next year.
All right. Okay, so that is forecasting. All right. And then the last topic that we learn before we holiday so long is
Cash flow.
The forecasting cash flow.
Cash budget.
Cash flow.
Yes, the
Yeah,
budget.
cash flow.
All right. So what do we learn in cash budget?
We learned how to forecast the cash flow.
We don't have to forecast the cash flow.
We learned.
Yeah, we learn about how to forecast for cash flow. When we
Yeah.
talk about forecasting pro forma, this is more than 1 to 3 years. Cash budget is less than 1 year. Okay. So in cash budget, we learn that the most important things for cash budget is when the cash
Yes.
comes in, and also how much. Because cash inflow minus cash outflow equals to
Net
net
cash flow.
cash. Right. So that is actually what we have been learning. So we learn business organization, we learn about financial institution, we learn about financial statement, we learn about financial ratio, we learn about financial forecasting, and finally we learn about cash budget. So today we are learning another one, which is working capital management. Right. Okay. Now, so in working capital management, we're going to see a little bit on theoretical parts, which is in risk and return trade-off, and also cash working capital management. Cash conversion cycle will be a bit of calculation, and let me tell you, cash conversion cycle is also where's my pointer? It's also a favorite of mine. Okay, and finally, there's a little bit of theoretical parts of management of current asset and also current liabilities. Okay, so what is working capital? So working capital, when we talk about capital, it is our budget, the money that we have inside our wallet, or the money that we have inside our cash reserve, petty cash kind of things. So it encompasses the day-to-day. It's a daily kind of thing, activities of managing the company current asset and current liabilities. Okay, so working capital represent a significant proportions of total assets. So working capital are also often referred as net current asset. So remember this, that working capital means that we work for, not we work for it lah, but the capitals that will change very, very frequently compared to non-current. So net current asset is the thing that we do or we use day to day. Okay. For example, let me give you a easier example to understand. Every day you put money inside your wallet, right? Maybe 10 ringgits, maybe 50 ringgits. So that is your working capital. However, there will be times that you're going to buy, maybe once per month, you're going to buy big stuff from Jasco or from Aeon. So you need much more money than that. That is not working capital. The working capital is the money that you put inside your wallet every day. If it changes sometimes, that is not considered as working capital. That is just non-current because it's not exactly everyday kind of things. Now, so net current asset is usually defined as current asset minus current liabilities. Remember this. So net current asset is current asset, whatever you have in terms of very fluid liquidity of cash minus with current liability. So for a firm to become very good, to become extremely well or smooth companies. Okay, so the net current asset must be positive. So meaning that the current asset must be bigger than the current liabilities. So if we have bigger current liabilities, then our net current asset will become negative. We don't want that. We want it to be positive. We want that we have more money than what they were going to spend. Okay, we don't want any debt. So net current assets must or should be positive for it to be liquid. So what is the factors that actually influence the capital management? Because sometimes 1 month your working capital might be a little bit higher than let's say in January your working capital is 10 millions. In February it's only 5 millions. Okay, it can change month by month, day to day, weekly, depends on these 4 factors. The first one is the type of business. So manufacturing and retail firms have higher working capital requirement, especially in the form of inventory as compared with service organizations. What does it mean? In terms of companies that have products, like they are selling chairs, or they are selling iPods, or they are selling books, okay? So that is considered as their asset. So their asset will be bigger when compared to service. Service like tourism or consultancy, they don't have much of inventory because their inventory is their services. Okay, so it is not tangible. So type of business does affect the working capital's volume, whether it be big or whether it be small. The second one is volume of sales. A higher level of sales will require a higher level of working capital. This is also affected by, for example, your inventory, right? So if you have a lot of chair to sell or to sold to other people's, so you need bigger money to pay for your salesman, right? So in order for it, you have to do a lot of promotion. So you need higher capital. And then seasonality. Season usually happens to companies like the ones that do fashions or food, right? When it's Raya season, like what we are currently done or what currently do, there is a higher peaks for if you want to buy baju kurung, so or if you want to buy shopping, right? So it is higher seasonality. So peak season, for example, festive season require higher level of working capital. So you want to open a shop, okay, during Raya season, okay. So in order for you to do the transactions of it, you need some changes, right? So people, let's say people want to buy your baju Raya for 150 and they give you 200. So you need to have at least 50 ringgit in your cash reserve, your that machine that cash currency kind of thing. So that 50 ringgit that you have is considered as your capital. You need to have the change or the balance before you can people can pay to you. And then we also the capital management also will be affected by length of operating and also cash cycles. Okay, in cash cycles, you're going to see it later on, especially when from you're selling it, you are going to start from the production of your inventories, goes to sales, and then goes back. So the bigger your cash cycle, okay, the higher the requirement of your working capital. And why? Because you need bigger time in order for you to get the money here. You will only get your money here. So when it's bigger, means that it is more days. More days.
Hmm.
This one maybe 7 days you will get into sales. Here, mungkin you need until 14 days. So in order for you to pay for your bills, to pay for your workers, need higher working capital. So far so good, guys?
So far, so good.
Alright, okay, good. Now, so how can we measure the firm's liquidity? Okay, because we need to know the firm liquidity or our firm's liquidity. Can we pay? Or are we positive or are we negative? So the firm's working capital choices are critical determinants of its ability to pay its bill on time. Even yourself, if you need to pay for your telephone bills or internet bills, you need to check whether do you have enough money to pay it. So how can we check it? By using one of the financial ratio that we learned previously, which are current ratio. So the current ratio is current asset divided by current liability. So it's a popular measure of firm liquidity. So basically you have two ways to see it. Either you minus current asset with current liabilities, just a simple minus, or you divide it. Current asset divide with current liabilities. So in terms of liquidity ratio, if the current ratio is greater than 1, then the net working capital is positive.
Positive.
So if the current ratio is less than 1, then the net working capital will be negative. Okay, for example, current ratio is more widely used because it allows for comparison across the firms of varying size. So based on the table, so we have firm A and firm B. All right, can you guys calculate for me firm A net working capitals and firm B net working capitals and firm A current ratio and firm B current ratio? What is the formula for net working capital is?
Current assets minus current liabilities.
Yes, that is correct. Current asset minus with current
Liabilities.
liabilities. And current ratio is
The current
current
assets
asset
Current assets
and
divided
current
to
liabilities.
divide by current
Liability.
liabilities.
liability. Okay, so what is our net working capital for firm A?
25,000.
25,000 ringgit.
25,000.
Diana, can you calculate for me the net working capital for firm A? Shazad, can you calculate for me the net working capital for firm A? Najiha, what is the net working capital for firm A?
55,000.
5,000. Oops. $5K. All right. Azrul, what is the current ratio
25.
for firm A? Oh, sorry,
25.
25K. All right. Azrul, what is the firm B net working capital?
2,500 from B.
2.5K. All right. When we are looking at this one, net working capital, which is bigger? And why already ask? Nasir, which one is bigger?
From A.
Firm A is higher or bigger, right? Okay. Now, Aziza, what is the current ratio for firm A?
50,000 divided by 25,000, so 2.
So, all right. Ali, what is the current ratio for firm B?
2.
2.
Okay.
So it is the same,
The same.
right? So what does it mean here that despite that the firm A, when we are looking at the net working capital, it has higher one,
Yes.
but the current ratio is
The
actually
same.
similar. So here, current ratio is widely used. It is better used because it's allowed for comparison across firm of various sizes. It doesn't matter, perhaps, despite the facts that the net working capital of firm B is lower, maybe their bills is smaller. So, they don't need that much of reserve. They don't need 25K. They only need 2.5K.
Yes.
How can we know? Because we see from the current ratio that it have similar current ratio with a bigger companies. So that's the reason why it is much more better to use current ratio. However, if the question asks for both, then you can use both. But if he asks for, can you compare between two companies in terms of their working capital? So the best value. So in that case, you need to choose one of them. So if you choose net working capital, then I have to deduct marks because it's not the most suitable comparison. Current ratio is most suitable comparison. You guys get it?
Yes, teacher.
Doctor.
All right. Good.
Yes.
So now, this is a checkpoint. So basically, you have your cash and cash equivalent for 2020, and then you have for 2018. So you have account receivable, you have inventory, you have total current asset, account payable, other current liabilities, and total current liabilities. So this is Ford Motor Companies suffered along with all other industry with the onset of COVID-19 outbreaks. The following information from the firm financial statement for 2018 and 2020 provide the information need to assess the firm liquidity. So calculate the Ford Motor Company firm's liquidity. So basically you need to add up all the total current asset where we got here and then divide it with total current liabilities. When that happens, I would like to see something like this. This is not in your final exam lah. This is like, for example, in your research, or you are doing some reports, assignment for me for this kind of manner. So you can see in 2020 and also in 2018. Okay. Now, that is about working capital. Now, the third or the second parts of it, we're going to see the risk-return trade-off. I'm going to give you 5-minute breaks first, okay? So I'll see you back at 10:40. All right? So go take some water and go so for your toilet breaks or everything. And we'll see you back at 10:40. See you. Okay. Now, so the next part that we're going to see is about investing or working of capital management. So when you have working capital management, sometimes you're going to do it to do investment, not investment kind of thing. So the risk-return trade-off in working capital management. Now let me get everything to clear up. So it's actually the risk return trade-off is actually a principle that states that the potential return rises with an increase in risk. Okay, so using these principles, low level of uncertainty is associated with the low level potentials of returns, and high level of uncertainty or risk with high potential returns. Means that if you go big, your return will be big. If you go a bit small, then your return will be small. So according to the risk return trade-off, invested money can render higher profit on the investor will a higher possibility of losses. Okay, so now what does it mean that in terms of risk and also return, when you are using any investment that have low risk, for example, something that when you are doing your financial set, it's for example ASB lah, something like trading for something that is very consistent. Okay, so the return that you get will be smaller as well. So low risk, low return. However, if you go for high risk, something that either you're going to lose everything or you will get 1 million of it. So it becomes a high risk of it. So the chances for high return is better. Now, let me share with you something first. Stop sharing. Okay. I did not share with the volume of it. Wait, let me share back. All right. Okay. So let me show you, or let somebody else talk about what is about risk return trade-off.
Hey everyone, today's
Can you guys hear it?
Yes, Doctor.
finance
Doctor,
lesson will be on the risk return trade-off. The risk return trade-off is an important concept in finance and investing and is the basis for many complex theories that we will look at later. So on today's lesson, we will talk about risk and return, individually and collectively, the trade-off and how it relates to bonds, and lastly, we will take a look at the economy's role in the risk and return trade-off. To actually define the risk-return trade-off, we must first define risk and return separately. Risk is the probability that an investment's actual return will be different from the expected return. Risk can be low. In other words, the chance that an investor will lose some of his investment. Or risk can be high. In other words, the chance that an investor will lose most or all of his investment. Return is simply the profit on an investment. It can be measured in absolute terms or in percentage terms. Now we can define the risk and return trade-off. The risk and return trade-off is a proportional increase or decrease of return to an increase or decrease of risk. Investors generally look for an investment that will give the highest possible return for the lowest possible risk. More simply, by looking at this graph, we can conclude that high risk equals high potential returns and low risk equals low potential returns. An important thing to remember is that high risk means a higher potential return. It does not guarantee a high return. In general, whenever there is a risk, there is a chance of return and an equal chance of loss. Now let's look at a real-world example. Bonds. A corporate bond has a higher risk and a higher potential return than a government bond. Why? And a company may default on its loan or shut down. On the other hand, a government bond is issued by a country's government, and a government can raise taxes or print more money to redeem the bond at maturity. In general, a government's chances of defaulting on a loan or shutting down is almost impossible. A more in-depth lesson on bonds will be covered in a later video. Economic conditions also dictate the amount of risk an investor is willing to take on. If the economy is in recession or if unemployment is high, investors will be less inclined to purchase risky securities and will thus expect lower returns during that trading season. For example, during the recession of 2008, Mark Zuckerberg lost $600 million and Bill Gates lost $18 billion. The market crash, the recession, and increasing levels of unemployment resulted in a bear market in which investors targeted low risk and low yield securities. Now, to summarize, the risk and return trade-off is a valuable concept that is used in many investing strategies as well as vital corporate finance decisions. In future lessons, we will be referring to the risk-return trade-off, as it will allow us to look into other concepts more deeply. Now that wraps up the lesson for today. If you have any questions or concerns, please leave a comment down below. Thank you for watching.
All right. Okay, so that is about risk return principle. So I won't go too much of it because I just want you to know what is risk return trade-off kind of madness. It's only the introductory principle of it. If you would like to go or to know more, you can always go search this on internet to understand about it. Okay, now the second or the consequences of risk return trade-off is about the principle of self-liquidating debt. So in managing the firm's net working capital involves deciding on an investment strategy for financing the firm's current asset and liability. So since each financing sources come with advantages and disadvantages, we actually must decide which one that is you should use in order to pay. For example, you have this kind of assets, and you need to pay for this kind of debt. Okay, which assets that are going to pay for which debt? So in applying the working capital policy asset can be divided into permanent assets and also temporary asset. And in terms of the debt or financing, the source of financing, the source can be either the permanent source, temporary sources, or spontaneous sources. What does permanent asset, temporary asset means? We'll see it after this. So, however, a benchmark that is often used for setting working capital policy is the principle of self-liquidating debt. That straight up pay. So this principle stated the maturity of the source of financing should be matched with the length of time of the financing is needed. So funds that are needed for limited period of time, and when the time have passed, the cash needed to repay will be generated automatically by the sales. So meaning that maybe you have to pay in 1 year, you don't exactly have the money today, but in 1 year time, when you already finish or when you already do your one cycle of sales, you will have the money to pay for it. So it is self-liquidating debt. You don't need to actually raise the money will come automatically based on the marketing or the sales that you have conducted. Okay, in terms of buildings, right? When you are doing buildings or constructions, so for you to pay to the banks, your investor, all the loans and everything, so you need maybe in order for you to do a house, you need 1 year or 2 years, let's say. And in 2 years, you have to pay to the banks the money that you have to pay to the bank the money that you loan or you borrowed. However, because you can now sell the house that you've constructed in 2 years, finish. So you sell it, you have the money, half of it you can give to the bank to pay for your debt. So it becomes a self-liquidating debt. Okay. Obtaining the need source from a long-term source more than 1 year would mean that the firm still have the funds after the inventory they help finance have been sold, or excess liquidity, which might need to invest in low-yield marketable securities. So for example, sometimes your sources come from long-term sources. That means that you can actually use it somewhere else first. Okay. I give you a what happens with my auntie? Was it considered as my auntie? Yeah, okay lah. All right. So, me, no, my mom, my auntie, and I were supposed to go to Russia this year. Okay, we have a holiday trip to Russia this year. However, because of the Russia-Ukrainian conflict, we can't go there. But I already paid everything. Okay, I already gave, because this is the planner is my auntie. So I already paid to my auntie all the money that required for the ticket flight, for the hotels, for everything. I already paid to her. She have already paid to the agents, to the agents, to the hotel, to the grounds, everything. And with her, got still, let's say 3,000 of my money with her. That is money for ground transportations or everything. So that money is considered as source. Okay, in here, the source of it. And the financing is all the things that will happen in Russia later. Maybe we have to buy some keychains, or we are going to buy some foods to eat, or anything that will happen shopping times in Russia. Okay, so that is financing. Now we have 3,000. I have 3,000. So we are not going to use that money now, okay, because we are still not going to Russia yet. So what my auntie did, she put that money on an investment, okay, a low yield investment, an ASB. So that 3K is in ASB, currently generating more income. Okay, so when the time comes, she will take back the money, the 3,000, and she has some extra money from the generations of investment. Okay, so that generation of investment perhaps will pay any debts that will happen when the our trip will goes on. So it is a self-liquidating debt. So it will pay it back when that happens. Yeah. I learned a lot from her as well, how to do. But it's a good seeing of everything. Another good things that I learned from my auntie is because she is teaching account as well, just like I did teaching you guys financial, right? I think so also. So basically, yes. So basically, another thing that she teach me, which is very good, is if you have extra money every month or every year, to turn it into currency that is bigger. For example, in Johor, we are quite near to Singapore, and Singapore currency is quite stable compared to Malaysia. Malaysia can go up and down, up and down, but Singapore is. So what we did, if we have extra money, we split it into two. One half of it, we save it in account for our liquid, meaning that sometimes maybe I will kind of visas or tires broke down or everything. Sometimes payment of maybe accident or whatsoever, that's the money. So that Singapore dollar, I will save it, and then maybe when I get the money from that as well. So that is a good investment as well for you guys. If you can change it into Singapore dollars, you can change it into another one, so who is Switzerland franc, I believe, and also US dollar. US dollar, you can actually save it if you want to go for a trip. because a lot of companies accept US dollar. All right, so that is some of the things that you can actually do yourself, whatever you want to do. Okay, so far, any question?
So far, so good.
So far, so good. All right. Okay. So, we've talked about asset a lot of time, right? Before this, I do believe that I give example of what assets and everything. But however, in here, when we talk about permanent asset and temporary asset, it is actually a little bit more specified. Okay, can you guys hear me now?
Yes, Doctor.
All right. Okay, I'm so sorry. I
Yes,
think
doctor.
just now the internet was suddenly goes a bit, I don't know.
Unstable.
Okay, I'll
Okay,
share.
doctor.
Alright, okay. Now, so what does permanent current asset means? Sometimes in your daily life, you will require or in a company, you have to pay some types of bills every day. So let's say you have salary, which is let's say 5K that you need to pay to all your workers and all your whatever vendors, okay? Salaries and then to bills. 2.5K. And then maybe some miscellaneous. Whatever happened, right? Another 2.5K. So this is daily payment. Okay, or not daily lah, daily. Monthly. That you need to spend at least for your company. For salaries, for your worker salaries, any bills and any miscellaneous. So in here, 5K plus 2.5 is 10K. Okay. So this 10K is considered as your permanent current asset. You need at least 10K every month in order to operate your companies. So
Like sustaining.
something like that. Yeah.
Yeah.
So if you have less than 10K, you cannot operate your companies. If you have higher than that, that's okay because you only need a minimum of 10K. So this is your permanent current asset. Whatever come up from that, whatever higher than that is considered as non-current assets. It fell into all non-current asset of firm will automatically fall into the category of permanent asset. And temporary assets are current assets that will be liquidated and replaced within the current year. This one is I think it's just straight up. So, but this is important. What does permanent current asset? In terms of sources of financing, we have permanent source, temporary source, and spontaneous sources. In terms of permanent sources, are financing with maturity periods of more than 1 year. So medium term loan, common stock, preferred stock, and non-current liabilities. Okay. And then we have temporary sources. For example, short-term financing comprising current liabilities like short-term notes payables, unsecured bank loans, commercial papers, loans secured by account receivable, and also inventories. Another thing that sometimes is financing is provision. Provision can be long-term or short-term depending on the years of it. For your final exam, some of the, let's say you're using financial statement, you will see some very interesting new terms happens. Okay, maybe I'm using provision, maybe I'm using commercial paper. So you need to understand, if we're talking about commercial paper in balance sheets, is it liabilities or asset? So you need to understand this first before you can do the question. And then we have spontaneous sources, which consists of trade credits and other account payables that arise spontaneously in the firm's day-to-day operations. So, for example, wages, salary payable, accrued interest, and accrued tax. Okay, so there are a lot of alternatives towards working capital policies. You have other policy chosen like hedging principle. This is an hedging principles, meaning that how you're going to pay for it. It's not much lah. I just want to introduce you the wording that you can actually go and Google later on to check what is it, conservative approach, aggressive approach, in order to for your working capitals policies. Okay, I'm not going much into this because no points of it in our class. However, if you are interested to know more about working capital, you can check this out by your own. It's a self-learning experience. All right, okay. So cash conversion cycle is actually calculation, and now it's 11:06. I'll see you back at 11:10. So clear you up. Go find your calculator because we are going to use calculator after this. Okay, so shall we start? Have you go take your calculator already?
Yes.
Okay. Oh. Okay, now cash conversion cycle. Cash conversion cycle is what happened when your first produce or a product, your product is actually cycle is like this. To you're selling it, okay, sometimes you have to sell it using credit, okay. When you sell it through credit, you have to wait until you get the money. Receive
Gosh.
payment. Guys, is it possible for you to mute for a while? When you have question or you want to answer, then only you unmute, because there are like statics mute noise on me that I cannot this. All right. This looks okay. All right, okay. All right. So you receive payment from your customers or your client. Oh, shoot. This is from your client. And also when you have to pay to your suppliers. And then you produce another product. So this is cash conversion cycle. Okay, when you have to pay, when you're selling, your client receive payment and you have to pay back, to pay to this supplier, yes. Okay, because this one, money in or money out? You receive payment.
Money in.
Money
Money in.
in. And for this one is money,
Out.
you have to pay. Money out. Good job, everyone. Yes. So you have produce product, money in, and also money out. All right. So the cash conversion cycle, or what we call CCC, is the length of time from beginning of production process to the point where the cash is collected from the sale of finished product less than the average payment period. Less average payment period is what your payment to supplier is. So the formula for it is ICP, which is inventory conversion period, ICP, plus with RCP, or receivable collection periods, or what you call DSO last time, day sales outstanding, minus with payable deferral periods. This is what you have to pay to your supplier. So that's the reason why it's negative, minus, because this is money out, this is money in. However, in cash conversion cycle, we are not looking for money, we are looking for days. How many days? So ICP plus with RCP minus with PDP. So this is money in, this is money out.
Out.
Okay. So what is ICP, what is RCP, and what is PDP? So ICP, or inventory conversion periods, is when you have raw material and you turn it into finished goods and then to sell them. So there are two types of formula that you can use. It depends on, this is a good question. One of my students always ask me, Doctor, what happens if they are sales and COGS? You can choose one of them. I will take any answer. Either you are using the formula inventory divided by sales divided by 360, or inventory divided by cost of goods sold divided by 360. Okay, so for example, if that question have sales only, then you have to use this formula. If the question have COGS only, then you're going to use this formula. If got both, then you can use either one. I will provide with both answer, no problem. So this is ICP. It is the average length of time required to convert materials into finished goods, into your products, and then to sell them. From raw materials into you sell them. This is selling. In terms of receivable collection periods, this is actually just your DSO. Okay, so period day sales outstanding is just receivable divided by credit sale divided by 360. I know for a fact that for, if I'm not mistaken, for financial ratio, you're using 365. However, for RCP, that's the reason why I'm not using RDSO here, because I don't want you to get confused. For RCP, is divided by 360, where from customers' unpaid invoice to the money that you will get. Okay, average length of time required to convert the firm's receivable, which is the unpaid invoice, into cash. You get the money from your client or from your customers. And finally, payable deferred periods is when you buy from your supplier and you have to pay them. The average length of time between the purchase of materials and labors and the payment of cash for them. So PDP is payables divided by COGS divided by 360. Any questions so far?
So far, so good.
All right. Okay. No question from you guys. I have questions. So Commodore Industries, a manufacturers of electronic equipment, has annual sales of 10 million. So the sales here is already given, which is 10 million. COGS is 70% of sales. Okay, so 70 out of 10 millions is 7 millions, I guess. Yep. So the average inventory is 1.52 millions, average receivable is 1.1 millions, and the average payable is 0.5. So what is the CCC for commodity industry? So the formula is ICP plus RCP minus PDP. If you remember, for ICP is actually
Is inventory.
inventory divided by sales or 360, or inventory divided by COGS 360. So
Question, teacher.
what's your question?
This ICB, when we choose one of these formula, the answer it will be
I just tell you just now.
yes.
I just mentioned this just now. So which one should you take?
The sales, each of them, one of them.
Yes, whenever you can take. I'll just give you one example. If you want to use another one, that's okay. I'll still accept your answer. No worries.
Okay.
All right. So in here, 1 to 5 is the average inventory divided by COGS. I'm using, no, sorry, not using COGS here. I'm using sales. Sales divided by 360. So, and then plus with receivable divided by the sales divided by 360. And then minus with the PDP, which is 0.5 millions divided by COGS divided by 360. Here, because it's RM, so it becomes unitless, but 360 is days, so you got days. So 1.25 millions divided by 10 millions, 360, you've got 45 days. This one, you got 40 days, and then you can minus with 26 days. So your CCC is 59 days. The shorter the CCC, the more profitable it is for the firm, as it would mean that the length of time between paying for material and labor and collection of receivable is shorter. So you want the number to become smaller. So if you calculate, you'll get 59 or 50 or 30, take the smallest one. Meaning that when you do comparison, some question, final exam question, you ask which one is better. So you have to choose the one with the lowest value. All right. You guys get this? Any question?
So far, so good.
All right. Okay. So we want to make sure that we can have shorter CCC. So how to reduce it? To increase the inventory turnover without causing any stock up that result in lost cases, which means that we are going to lower our ICP. We also want to lower our RCP by improving our debt collection procedure so as to collect cash outstanding faster without pressurizing customers so that sales will not be lost. And we would like to increase our days on PDP, which means that we settle account payable in the slowest way possible without damaging the firm's credit rating. That's the things I've been telling you, I think, in the first time. The principle of any financial, we want our money fast, we want to pay late. That is business. You pay me faster, I'll pay you slower, but without damaging the firm's credit rating and without pressurizing the customers. So how to reduce CCC? is decrease the ICP, decrease the RCP, and increase the PDP. Alright. Now, for your example, Syarikat Sentosa collects its account receivable in 50 days credit sales are made and pay its account receivable obligation in 28 days after credit purchase are placed. The firm cost of goods sold average 200,000 and its closing inventory amounts of 30,000. Can you calculate the the firm cash conversion cycles? And let's say if the firm able to extend its payment to 35 days by using new suppliers, but as a result lengthen its conversion period by 4 days, should the Syarikat Sentosa switch to new suppliers? You have 11:23, 15 minutes to answer this. 15. I would like to know the firm conversion cycles and should it change its payment or not. Your 15 minutes starts now. Alright. So what is the firm cash conversion cycle?
Cash conversion cycle is 76 days.
76 days. Yes, it is. Oops, dia dah keluar. Okay. So if the firm is able to extend its payment to 35 days by using new supplier, but as a result lengthen its conversion period by 4 days, should Syarikat Sentosa switch to new suppliers? Yes or no?
Yes, because the new cash conversion cycle is 73 days.
Yep.
It's less.
So it's less. So CCC is 76 days. So how can we get 76? So what is the inventory conversion periods?
Uh,
Okay,
54
how to
days.
calculate it? Inventory conversion period is
30,000 divided
20.
by 200,000 over 365.
200,000 divided by
No, 30,000 divided by 200,000 over 365.
$30,000 divided by
200,000.
200,000 divided by 360.
65.
So you got
54.
54, please.
54.
Yes.
But this is, Doctor, 54 point something. We should last time when we calculate the days, you told us when it's point something, it will goes directly to the. We will add 1 day more.
Later. Not now. Okay. Receivable collection period is receivable
50
collection
days.
50.
50 days.
50 days.
And payable different periods
28.
28
28
days.
days.
28 days. So 54 plus with 50 is 104.
Yes.
50 minus 22.
It's become
Yes,
76.
22 and
76.
yeah,
Yes.
76.
Now, why is it that we did not consider this one? Yes, if it's something like this, you can use it. However, for me, because that one is for DSO.
Yes.
Remember? Not about inventory conversion periods. So if you're using 54, I'll still accept it. Does that answer your question?
Yes.
All right. Okay. Now, if the firm's able to extend its payment to 35 days by using new suppliers, 35 days is what?
35 days.
PDP.
It
PDP.
is maybe
Yes.
B.
That is PDP. Okay. But result lengthen is conversion periods. to 4 days. That one is for
For the ICP.
ICP.
ICP. So from 54, you have to plus another 4. And then, however, it doesn't say anything about your RCP, so you're using the same
50 plus 50.
RCP. So that's the one, and reason becomes 73 days. So it become yes, because it's lower compared to 76 days. All right, good job, everyone. Now, so the cash conversion cycles, everything should change. Okay, so I would like you to do this checkpoint as a additional mini assignment, because some of you did not send some of it, so I would like to put this as your bonus mark. So if anything happens, I can actually add up to your marks. Okay, if not, it will be very difficult for me to, when you are going to ask, doctor, can I get marks and everything, I don't know where to get it. So try to do this as your homework and upload it. If you don't want to do it, that's fine also. But if you're doing it, you can upload it and I'll consider it as a bonus marks for you. All right?
Alright, give me some bonus
Okay.
marks.
Everybody needs more marks, right? Okay. All right. Now, management of current asset and current liabilities. So this is actually just theoretical parts of it. You can read this more about what is current asset management include, which is management of inventory, account receivable, cash and marketable securities, and current liabilities management include accruals, accrued payable, notes payable, and short-term loans. So some can come from secured sources and other from unsecured sources. Secured sources like banking, unsecured sources maybe like your parents and whatsoever. So that's it. Yeah. So you will have another quiz, which is 5 questions in 10 minutes. I don't think 10 minutes is enough, but let me check. I'll go back to you because there will be some calculations this time for quiz part 2, and it will be on your e-learning. Now, what I want you to do is, what date do you want this to happen?
Oh.
If it's okay for all of others, next Tuesday.
We very early, next Tuesday.
Maybe
Everybody,
next weekend.
when?
Next
Oh.
weekend.
Next weekend is okay. Next
Yeah,
weekend
yeah,
will
next
be
weekend.
Maybe 27 or 28.
27 of 27 Friday will be quite difficult for some guys. How about 28? 28 May, is it okay with everyone?
Yeah,
Yes,
yes.
that is okay.
Okay, 28 May 2022. Just like last time. So you can use the whole day of it to do this. I won't remind you. So you have to do it by yourself. Okay. So just open to the e-learning, go to quiz number 2, and you will get the quiz parts of it. All right.
All right.
Alright, doctor.
It's, you can, if you remember, you can always just tell your friends about this. Okay. Sharing is caring. So 28th May 2020, Saturday is going to be your quiz number 2. All right. That's it actually for our class. Woohoo! Do you have any questions so far about, if not the question for this one, maybe for your final exam or whatsoever? I do believe that I give some of a hint of what going out during your exam. But do you have any questions so far about the final? Oh, next week won't be me anymore. It will be Dr. Izzy Adiana. So she will carry on with the second parts of your classes. And I shall be only meeting you during the final exam time. Any question about final exam or assignment? I do believe that assignment you already sent, right?
Yeah.
Yeah, I think it's done. Most of you have done it, right? It's good thing that we don't have big assignment or big projects, so you don't need to think too much of it. Right? No question about
Any-
final exam?
Any tips need to be taken during the final exam?
You have to bring your calculator and to make sure that you are well equipped with your financial ratio formula.
Okay. Thank you.
You're welcome. Anyone else?
Doctor,
Yes.
can I know the answer for the previous assignment?
Oh, previous assignment was which one?
Or ke mana?
Cash budget, is it? Yeah, cash flow.
Ah, yes.
You want the answer for it? What is the question? Let me check. So, let me open it up. Open folders. All right. Your question is this one, right? No, the mini assignment. So this should be, let me stop sharing first. Let me share all. Okay, so this should be this one, Lotus Incorporation, is it?
Oh, yes, yes.
Yes. This is the last one.
Okay, so this one. So basically, share back. Open it up first. All right. So you have Lotus Incorporation have sale of 10,000 in January, 80,000 in February, and 90,000 in March. So the company forecast sales for the coming month is as follows. April, they got 110. May is 100 and June is 120. And additional information is that it have cash balance in April 20,000. 40% of the company sale is cash, meaning that everything of it you need to only account for 40% first, then the rest is 60%. Trade debtor credit sales are collected as follow: 20% during the month sales, 50% during the first month following the month of sales, 20% second month, and 10% is third month. And anticipates other cash incomes as follows as April, May, June, blah, 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 all sorts. Okay, so the first thing that you need to do is to put all the basic information first, because this is required for month April, May, and June. So you've got April, May, and June. Your opening balance, and then your add or your cash inflows, cash availables, less cash inflows, and then your net cash. Okay, so all of this is considered as your cash outflows later on. Now, so first opening balance is 20,000. This is considered in April. Cash balance of 20,000, 20,000 here. And then cash sales is 44,000, which is 40% of the company sale in cash for April. So 110 of 40% is 44. For May is 40,000, and for June is 48,000. So it's 40% out of the company sales in cash. This one. Okay. Next, credit sales. So credit sales, you need to do another tables, because this is all the credit sales that you have to do. So in January, it says that 20%, so you are using only 0.6 because 40% you already got it. So 0.6, 20% for January is actually 10% because during the third month. So basically for January, it's actually the third month. Payment will get in April. So Jan 0.6 multiplied with 0.1 for 10% during the third month. January, you've got the inside the month, and then February, March, April. So it's actually the third one, not considered the month that you get it, because the month that you get it, you got 40% of it. So February, March, April for your January credit sales. So that's the reason why it becomes 0.6 multiplied with 0.1 multiplied with 10,000, which is from your January punya sales. And then in February, again 0.6 multiplied with 0.2, which is the second month following the month of sale. Okay, so this is for February. For March is 0.5, which is 50% during the first month following the month of sales. And April, you've got your 20% during the month of sales. Okay, 0.6 plus multiply with 0.2 multiply with 110, which is the April one, 110. There's no May, there's no June because it's still not during that time. So 55,800. In May, it will start in February. Because why? January don't have any more sales. Okay. May will not get any payment for January because the January will finish in April. So you start with February 0.1, which is 10% during the third month, and then 20% of second month following the months of it, February, May. So you get it from a 90,000 of it in March, and then you've got 50% of it, 110, and 0.6 in for May. So you add it up, you got 6,600. Same also for June, 0.6 because 0.4 is already paid during the month. So you have just to use the 0.1, which is the 10% during the third month, 0.2, which is the second month following the month of sale. This is for months of sale. This is actually for March. If you can check, March is 90,000. That's the reason why it's 90,000 here. In April, so the April is 110, and April is the second month following the month, 20%. Then for 50% in the first month following the month of sales, which is May. Finally, in June, you've got your 0.2% of it following of the sales. So 63,000. So you put it back, 5,800, 6,600, and finally 63,000. So you've got your cash availables because you've got others. Others is just that you have to pay it. So for example, you have others. Here's a trading fine. Oh, sorry, no. There's somewhere here would say 100. So you just put the others 100, 12,000 and 11,000. I do believe that you can find it somewhere here. Okay. And then cash availables. So you put up the first one opening balance in 20,000. So 220,000 plus everything up 129. And then the credit purchase. So you have to do it again. Credit purchase, cash outflow, rent, salaries, wages. There's no interest payment, equipments, and then you got 42,300. So 42,300 become your opening balance for May. So you add it up, everything back, and then you minus with the cash outflow, you get your net cash, which is 79,900. And this become your opening balance in June. So you minus with plus with the cash availables, all this cash available, and minus with cash outflow, and then you will get the net cash. It's kind of easy actually. It's just that you have to do it very slowly. All right. Any question?
Thank you.
All right. Okay. Okay. So nothing whatsoever?
No.
No. Let me go around the table. Ali, do you have any question?
No.
No.
So far so
Alright,
good.
okay. Fahad, do you have no Fahad? Aziza also okay, good. Nasir, do you have any question?
Doctor, thank you so much.
Alright. Zati, do you have any question?
No, Doctor.
Alright, good. Azrul, do you have any question?
So for final exam question, something, doctor.
I did already give some tips. You can check back from our ni nanti later on. Some star and everything. You can try it. For my parts, there will be separate. From me will be 2 questions. From Dr. Izzy will be 2 questions. My parts, question 1 will have 3 questions, A, B, C. Will carry 25 marks. And question 2 also have 3 questions, A, B, C, which carry 25 marks. The questions that come out will come out from based on from week 1 until today. Yeah, everything I guess. Yeah. Everything I touch a little bit of it. So
Answer all, Doctor.
yes, answer all. Okay, you've got 3 hours to answer all. And most of the time, student will go past that 3 hours, but also going to wait for you. But try not to lah, because it's kind of tiring. I can't remember what time is your final exam. The final exam schedules came out already?
Yes.
What time is it?
For,
Not the
14.
date, just time. Is it morning or afternoon?
I think it's 9 o'clock.
Afternoon.
Morning. Okay, morning is better. Because in the afternoon, people will get very tired already. All right, Najiha, do you have any question?
No question, Doctor.
All right. Diana, do you have any questions, sayang?
Don't have, Doctor.
I just wanted to try.
Okay. Salim, do you have any question?
Thank you, doctor.
All right. Sazat, do you have any question? I am pretty concerned about Sazat, whether he's here or not. All right.
Yes, doctor. Yes,
Alright.
doctor.
Do you have
Is it
any
good?
question, Sazat?
No, doctor. No,
All right.
doctor.
Okay. If got no question, I'm going to stop the recording.